Howdy, it's Casey here. I appreciate you joining us on this quick little video. It's going to do a real quick high-level overview about how we've structured our business to help both sellers of properties that are in tough spots and people that want to become a homeowner. They don't think they can qualify for a loan, how they can do that and become an owner. And we then generate monthly, consistent, reoccurring cash flow. The reason you're here is that we do have lenders that are looking to lend against that cash flow, hypothecating against the note that is secured by real estate. So we're going to start kind of at a high level, going through what we do. So we buy homes from people and we keep their underlying loan in place. So that loan with Wells Fargo, Chase, whomever it might be, typically these are families going through a foreclosure. We get the loan current and we take over those monthly payments. We then sell that property to a new homeowner, a new family, at a higher interest rate. It's an arbitrage between the two markets, and that interest rate spread is where we get our cash flow. Sometimes, and usually, there's even an equity bump or increase on that property as well. This allows us to generate those cash flows consistently every month, and it upgrades us from being a landlord to being a lender. Because, when you have a water heater go out at your home, you don't stop paying the mortgage. But yet, if you're a landlord, you do have to deal with that problem. We do rentals as well, but we highly prefer the notes because it definitely takes away a lot of the risk and some of the problems of being a landlord. And just like, again, if your HVAC goes out, you solve that, not your bank. And it's much easier to be the bank. The biggest buildings downtown have bank and insurance companies' name on it, not property management companies on it. There's a reason for that. So how we buy them is we do a lot of marketing directly to our sellers. So we reach out through our Google PPC ads to find people that are in situations they'd like to have solved. We solve a variety of different situations. As I mentioned, typically it's foreclosure. I've been doing this about 15 years. I used to do the full gut rehabs where we would go look at people that had taxes that were behind or inherited houses. Those are high equity properties that are great for flipping, but they're a little bit more challenging to do what we are doing with the notes. So we don't target those with our ads anymore. We really focus on those that are behind, would like someone to take over their payments. They bought recently and they can't afford to sell the home, but they have to move for work. There's not enough equity for them to sell in the retail market. We can still come in and help solve that problem. That's actually really great right now because a lot of the loans that are 2 years ago are those 3% loans, 2.5% loans. We then take that property and we sell it to a different buyer. Well, sometimes we have to do repairs and fix up the home. It all kind of varies, and we'll jump through that in a moment. But basically, we're going to go through and help them become a homeowner when they didn't think they could. So Buy House No Banks is a way that we can market to them. And we do the lending directly from us and a wraparound mortgage loan. It's a little detailed, and we'll come through some of those as well as we go through it. But we do a variety of marketing channels to try to get in front of people and then to really walk them through the process of doing this ethically and correctly. When they go through and click on our website, they're going to be able to fill out an application and give us a little information about themselves. It can be people of all types. A recent divorce. I have a mother of 2 children right now who went through a divorce and doesn't qualify for a home loan. They're literally living in a hotel, but she has good income, but they can't get a bank loan, and rent's really hard to make happen in the small town that they're in. There aren't a lot of availability. So she's putting a sizable down payment. And she's moving into a home that we were able to sell her, and she couldn't be more ecstatic about it. It's kind of rewarding and exciting to be able to help families like that on both sides of the transaction, not just our buyers, but our sellers as well. It could be people that have low credit score for a variety of reasons, no social or W-2, self-employed. We have a crazy notion that income and cash pays your debt, not a credit score. So we really make sure that our buyers have that consistent income. We go through an RMLO. That's it used to be just an ethical standard. Now it really is a legal standard to go through to make sure you're not putting somebody in a home that they really can't afford. We don't want the property back. We want them to be consistent homeowners for the next 30 years, or forever, but the loan for the next 30 years. Because we don't want to have to deal with foreclosing and all of that. We actually provide multiple payment plans to our borrowers so they can try to get their loan current. Life throws us all curveballs, and it's better to help them get back current than trying to foreclose and get someone new. That's always an option, but we really don't want to go there, and we work hard with our borrowers to not do that. We even work hard with them to keep their taxes and their homeowner's insurance low. Because if they can keep that expense down, they're more likely to keep their ongoing principal payments and interest every month to us. I have a whole list of things that we do that others don't do to make sure that we make that happen. But again, we're taking over a 3%, selling it at a 10. That rate spread is our cash flow. It's really pretty a simple process. Now, the way that the numbers work out is, let's say that on average here for 2023, we spent about $16.5 to buy a home. After our renovations and holding costs and other things, we're in it for about 29. Now, holding costs can be, insurance, taxes, utilities, stuff like that. We're in it for 29. Our cash in is going to be a down payment, lending points, whatever money we bring in during the closing transaction. And that then leaves us with how much we have left sitting in that house at that $12,000 per property. Now, if we're averaging $760 a month per property for the year, that averages out to a 75% cash on cash return, meaning that about a year and a half we break even. And then after that, it's a return on our investment. You can also see in the top right here, our average underlying loan that we're paying the monthly on is a 4.2. Our loan that we sell out to our end buyers is at a 9.5, giving us a 5.3 spread between them. It also goes to show we're making more money on the bank's money than they are. So let's say there's a loan for $100,000 to Wells Fargo at 4%. And if I'm charging 9% on a $120,000 loan, so from 100 to 120, that 20,000 difference, I make my full 9.5. But on from that 0 to 100, the bank's making 4.2 and I'm making 5.3. So we're making more money on the bank's money than they are. Now, this year, we also had a couple of big rehabs that we kind of regret doing. Took a lot more work to get done, a lot more expense to get done. If I actually take those properties out of the equation, our cash on cash goes up to about 130%, meaning about a 9%, 9 months until we break even on that property, even better than what we're doing right now. So that's where education and knowledge could not be more important. And experience here is something that a lot of people don't have yet. I've become kind of an industry expert. I do a variety of education. You can go onto caseystone.com, check out some of the socials of what we're sharing with people. And, a lot of things are important to do and some things are legal, but a lot of it's very ethical. So like the Senate Bill 43 is something that we do here in Texas. It's unique to Texas, but it's something that has a lot of hurdles in it and is challenging and it scares some people away. But if you do it right, it's just easier. And it just makes it all work for everybody. And that's what the Senate Bill 43 helps to ensure that the dirty players out there don't make it and they can go away. But that education and experience matters because it can prevent problems down the road. Half of the game is learning how to buy it correctly, how to work with that seller to take over their loan, to structure the deal, to do the disclosures, to get them aware of what's happening. Other half of the learning, which also takes years, is how do you work with your buyer? Again, what disclosures? What insurance disclosures? What sub-2 wrap disclosures do you have to do, especially here in Texas with SB 43? How do you articulate that conversation? Doesn't need to be in English and Spanish. Knowing how to do that right, again, is an ethical standard, but a legal standard as well. And it, more importantly, sets a standard expectation for all parties involved, ensuring a long, friendly, good relationship. And that's what we all need and want. Again, it's about cash flow, not about trying to get the property back. Earning an important reputation is important. We have really 5 stars on all our brands. The 4.9 on Stone, I'm still a little upset about. It's from a couple years ago. We had a wholesaler that gave us a 1 star because we didn't want to overpay for her property that she didn't even own. She's a wholesaler, wasn't a homeowner. We actually have over 60 reviews now, and they're still all 5 stars. So we think that'll come up to 5 here soon. But what we're offering is a secured lending opportunity. So in this example, there's a $50,000 loan that's taken out at 15% for 5 years. That's $1,100, let's call it $1,200 a month that we're paying back to that lender every month. So at the end of the term, it would be a $71,000 that they've received over the life of the loan. And that would be a $21,000 gain. Now, some people lend from their self-directed IRAs and they say, I don't, or 401ks, and say, I don't really want the monthly payment. I can't do much with it. So might as well just pay me back at the end. So maybe we did a 3-year loan with no monthly payments and it just continues to compound. And then at the end, it's one balloon payment all back into that self-directed IRA. That's something we can do as well. We usually do those at like a 10 or a 12% because it's compounding on itself. And it can get you a better return. Some people do it from their child's Coverdell's or an HSA account. A lot of ways to structure these. We've even done it some with lenders where we have an 8-year amortized loan that balloons in 3.5 years. So they get that cream of the top. They get the top interest on their loan, and then all the principal comes back in 3.5 years. Another way to get a really good return on that, because as you know, an amortized loan, the latter part of the loan, most of the money goes to principal and not interest. So you're not getting as good of a return at the end of it. So a lot of ways of structuring things. A lot of people ask me, why do we do such a high rate? Most people do 8 or 10%. We want our lenders excited. We want our lenders to go tell their friends and family about it, brag to everybody else. One, that's phenomenal marketing for us. But two, we want it to be something you're excited about, because then when we get you paid off, we come back for round 2 and we say, hey, you know what? We're actually going to go buy a mobile home park and we're collecting 40 different lenders together. Do you want to be a part of that investment? We've got the track record with you and you've already seen great returns, and we can go do it again and go do it again. It's not about getting as much juice as you can out of one lemon, but going to get another lemon and going to do it over and over and over. And that's velocity of capital. That's scalability. And that's the reason why we want to make it a good return. It's not about trying to just, get as little as you can out to your lender. And a lender their job is to get, or their role, I should say, is about getting passive, direct deposit, mailbox money every month that is secured and backed by real estate. The interest rate is important, but most of my lenders are also more interested and understanding how it's secured, and they're not going to lose their principal. And that couldn't be of more importance for us as well. Those warm and fuzzies really do matter. Now, what we do is it's a collateral assignment of deed of trust. So whenever we do allocate properties to your loan, and I go back to that $50,000 example here, we had a $1,200 the month that we're paying in this example. We basically assign 2 notes. It's really about $1,500 worth of cash flow that we assign to it. But that's the 2 properties that we then go assign in the county records a deed of trust of collateral assignment, so that there is that way that if you ever were not to get paid, you can go get the total remainder of that note given over to you. Basically means our worst day would be your best days. Instead of getting 3 or 5 years of payments, you would get 30. So we obviously can't let that happen on our side. It's a commercial promissory note. There's a loan agreements and all the documents. Is again, do it above board. Make it a win-win. It's not trying to hide anything. Let's make this a great opportunity that everybody can go and get excited about. This is not something we're trying to get rich quick. It's not a software company that's going to quadruple in a year and you're going to make a gazillion dollars. That's not what we're trying to do. It's not angel investing, and you're not investing in individual business hoping that business goes through. It's because you're secured by a loan, even if the whole business goes under. You've got the whole collateral assignment at the county records, so you are secured. The business is almost irrelevant because you're getting that return. It's a better return than you're going to get on a bond, a CD, a T-bill, any of that stuff. Those rates are actually coming down, especially here in 24 as Prime and the Fed's looking at lowering rates. We'll see those rates come down now. It's consistently paid back. And again, you're placed in a secured position against real estate. That's the goal. Make it a good, safe investment, but you still want the returns exciting. You want to get something, man, I'm killing it and I'm doing really good here. As with anything, there's always risk to talk about. One of the biggest risks is if the market were to drop 30%. Let's say that, everybody talks about the market. The media loves to tout how much the market's always about to crash. And it has crashed in the past. It always comes back, but it has crashed. But, if just because, think about your situation, just because Zillow says that your house is worth less money today than it was yesterday, do you stop paying your mortgage? No. It's the same thing with our borrowers. It's their home. It's not a rental. They're more tied to it because they are owners, not tenants. They don't just stop paying because Zillow says their house is worth less. Market drops hurt the retail market a lot more than our market. Our buyers are so excited about the loan opportunity that the retail market doesn't work. A lot of people in our shoes actually take advantage of that fact. They'll go to their buyer and they'll mark up the price above the retail price because they know that those people don't have an opportunity, so they're going to pay more for it. We don't do that. We still try to keep it to the retail numbers because it's not about, again, taking advantage of someone in that spot, but helping them to better their own life and to get things going. So yeah, market drops, not that worried. Like anything else, if they stop paying, we're going to offer them payment plans, but at some point you stop paying, you go. No pay, no stay. Which goes to borrower defaulting. Let's say that my borrower over at 123 Pecan stops paying their mortgage. Well, really, you're never going to know that as a lender because our loan servicer takes the monthly payments from all I don't even know, 80, 100 notes we have on our rental properties. They then pay all the debts, whether it's Wells Fargo, one of our hypothecation lenders. They pay all the debts and they send us back our spread. So you'll never skip a beat. And that's really important. You're not about in the game of managing a note, but collecting the cash flow. But we may have to call you and say, hey, that borrower at 123 Maple, they have failed on 3 payment plans. I need to move you from 123 Maple to 238 Pecan. Move you over to Pecan. I then get a clear ability to go foreclose, evict, get that property rehabbed, to get it back on the market and get it resold. And now I've got a new borrower in there with a new down payment. I can say, hey, you know what? We can move you back over to Maple. You can stay at Pecan. It's whatever you want. Again, we're looking at the bigger picture and making it very simple. We're very much structured to manage that whole process. We do foreclosures as often as we have to. We're very familiar with how that works, and we do rehabs on a lot of properties. That whole thing, we have team members scheduled to do it. It's not for our borrowers to get in that mix. One of the biggest things I do like to talk about is the due on sale clause, because that's where the lender, say Wells Fargo, has the right, not the opportunity, not the requirement. They have the option to call a note due whenever they see that the deed has changed hands. Now, we do a lot of things to prevent that. Again, I'll go back to having industry knowledge and being really an expert, if not an educator in the space, that has helped us to teach people how to prevent this. One is how you set up the insurance. Some people don't set it up correctly. There are a lot of things to it. I've even seen them called due because they didn't have the correct minimum insurance requirement, and they sent it to the lender. The lender has a $200,000 loan and they insured the property for $100,000. That's not going to work. Knowing there are a lot of names that need to be listed, additional insured and stuff like that in these types of transactions. Even if that happens, that's an all hands on deck problem for us to jump in and help solve. There are a lot of ways to solve it. Sometimes we've deeded it back to our original seller, got the bank to calm down. Sometimes we just mail the bank 2 months of payments. We never hear from them again about it. And really, a lot of these loans, they were non-performing. They were behind. The bank is excited about getting current, updated monthly payments coming in. As long as you secure the asset, you pay on time, they don't really care. You give them reason to get worried, then they're going to come in and want to investigate. So we don't give them a reason to get worried. We've learned all the pitfalls to prevent that. But even if they do, we know how to have the conversation to get it solved. Worst comes down to it, we could pay off the lender, which is always an option. You can sell the note, which is always an option. We can collateralize against another asset. There are a lot of things about the ways of doing it. Maybe some fun times. We can talk you through it and explain, hey, this is what's going on. This is how we're solving it. And kind of share that knowledge and experience as we do it. So a lot of information kind of went over here. It is something we take very seriously. We're very excited and proud of what we've built and what we're doing. Love to tell you more about it. Don't hesitate to drop me a message, shoot me a call, and I hope to talk soon. Thank you. Bye-bye.